Hi everyone. So I know that chapter 11 can be a little bit confusing, so I'm making this video to make things hopefully clear and that it will make more sense. There are basically three main decisions in chapter 11 and they can be pretty similar. One is the special order, the discontinuous segment, and the buy or make. For the special orders, basically what we're going to do is get the revenue for that special order and subtract the incremental cost or the relevant cost. So if the difference of those two is a positive number, that means it's an advantage. If it's a negative number, it's a disadvantage. When we're looking at this continuous segment, we're going to get the relevant cost again, or the traceable cost, and subtract the contribution margin of that segment. If the result, again, if it's positive, is an advantage, negative, disadvantage. If it's positive, it also means that the net operating income will increase, and if it's a negative, it will decrease. For the buy or make decision, we're going to take the price that we'll take to buy this product versus the cost that we'll have to pay to make it. The difference, again, if it's positive, well, in this one, it depends. If we're already making the product, we're going to take the make cost minus the buying price. And then if that is going to be a positive number, that's an advantage to buy it, or if it's a negative, it's a disadvantage and they should keep making it. And the opposite, if we're buying the product and we're thinking about making it instead, we're going to do the buy price minus the making cost, and then positive advantage, negative disadvantage. So we can notice that these are three different decisions, totally different, but there are three things that are all in common. The first thing is that the first step that we're always going to do are just taking the relevant cost. And relevant costs sometimes are called like avoidable or traceable, they're all synonymous. It's just the costs that are specifically for that segment or that product. So we're not going to care about the common costs that are for the whole company, or the costs that are sunk costs like depreciation, because they already happen and we don't really care. They're not important for this decision. So just the relevant cost. And the second thing that is in common of these three decisions is that the positive number is always an advantage, the negative is a disadvantage. And when they say what is the advantage or disadvantage of doing this, they mean what is the difference between two things. So the difference of a special order is the revenue versus the relevant cost. The discontinuous segment is the difference between the net operating income before versus the net operating income after they discontinue the segment. And the buy or make is the difference between, well, the price of buying it versus the price of making it. So I'm going to do an example with all these three decisions. There's also the decision of the constrained resource that I'm going to do at the end. And I really like Harry Potter, so I think it's a good opportunity to use Harry Potter and make this more fun. So for those who like Harry Potter, you know that the Fred and George Weasley, the twins, they created a business and it's called Weasley's Wizard and Wizards. Weezes. I'm sorry. I know it in Spanish, not really in English. They buy jokes and they buy sweets, potions, and it's a really fun business. It's a pretty cool idea. So hopefully we'll make things more interesting. Okay, so the first decision that Fred and George are going to make is a discontinuous segment. The Weasley Wizards and Wizards shop contains three segments: practical joke objects, muggle magic, and sweets. Fred and George are concerned about the continued losses shown by the muggle magic segment, and they want to find out whether or not they should discontinue the segment. So right here we can see all the costs for the different three segments and the total for the company, their sales, this variable manufacturing and selling expenses, the contribution margin, and all the fixed expenses, which are the advertising, which is traceable, depreciation of special equipment, and allocated common fixed expenses, which is the rent of the store, and the salary for Fred and George, which are the CEO. So yeah, as we can see, there's a net loss of 81,400 in net operating income for the Muggle Magic segment. So the first thing that we're going to do is the same table, but pretending that we're going to discontinue it. So if we discontinue the Muggle Magic segment, there are not going to be sales or variable expenses. Thus, contribution margin is going to be 0. And they're only going to pay those fixed expenses that are common, they have to pay even though if the segment is discontinued. So the only one right here is the allocated common fixed expenses, because the advertising is traceable. And when it says traceable, it means that it's only for that segment. The depreciation is a sunk cost. It already happened, so it's not important in this decision. And yeah, the only one that is left over is the allocated common fixed expenses. So they will have a net loss in this segment of 38,100 versus the negative 81,400. And the difference of these two is 43,300. So there is an advantage if we do the net loss after discontinue minus the net loss before discontinue. This is an advantage because they will lose less money, the 38,000 versus 81,000. So the other way that you can solve this one instead of making the whole table is using the formula that I showed before, the fixed expenses that are traceable minus the contribution margin. So we would add all the traceable expenses, which are the advertising traceable and depreciation, because even though depreciation is a sunk cost, it's still traceable for this segment. So these two together, and then we're going to subtract all these traceable fixed expenses minus the contribution margin of the segment, and we get the same answer. And because it is a positive 43,300, they should drop or discontinue this Muggle Magic segment and just eliminate it. Now, the second decision that Fred and George are going to have to do is the special order. One of the sweets Weasley's Wizard Wizards sell are a type of biscuit called canary creams. They sell them for $10 each, and these are costs associated with producing and selling them. So we have direct materials of $1, direct labor of $2, factory overhead of $10, and selling and administrative of $3. The variable portion of the factory overhead is $1.50 per unit. Harry Potter wants to buy 40 of them for only $7 each. The order will not require any selling or administrative costs. Harry will also pay for the shipping costs, but Fred and George will have to pay $40 inspection fee. What effect would accepting the special order have on Weasley's Wizard Wizards net operating income? So the way that we're going to solve this one is that, again, we're going to take all the relevant costs, so direct materials, direct labor, and because it says that only $1.50 will be relevant costs, we're just going to take that $1.50. There is no selling and administrative for this special order, so these are not relevant. And if we add all of this together, we get a total of $4.50 per unit. And remember that Harry wants to buy 40 of these candies. So let's do the revenue minus the cost. So the revenue is the $7 of the price times the 40 candies, $280. The total cost is the total per unit times 40. And then the inspection fee, which is a fixed cost for this special order, is 40. So if we subtract the revenue minus the total cost and the inspection fee, we get a revenue of $60. So yeah, they should accept this order because they're going to make money. Now, the buy or make decision. Fred and George create all their jokes products, including their boxing telescope. They recently received an offer from an outside supplier who could sell them each boxing telescope for $5. Would it be better to buy this product or continue making it? These are the costs to make the boxing telescope based on 1,000 units. So we have direct materials is 150, direct labor 3, depreciation at 130, variable manufacturing overhead is 30 cents, rent 25 cents per unit, and salary to Fred and George 25 cents as well. If we add them all together, we get a total of $660 per unit. So, but now again, we're going to divide and separate all the relevant costs. So direct materials and direct labor are relevant cost, and the variable manufacturing overhead as well. Depreciation, again, is a sunk cost, so it's not important for this decision. And rent and the salary to Fred and George, these are not relevant because even if they don't make this product but they buy it, they're still going to have to pay for rent and for their salary. So these are common expenses and they're not relevant for this case. So the total relevant costs are $4.80. And the outside supplier say that he will sell each boxing telescope for $5. So the difference is really small, it's only 20 cents, but they should keep just making them because they will save more money like this. Now there's another decision that is important and that we learn in chapter 11, and that's the constrained resources. So as we said before, one of the segments of this shop is the sweets, and there are 3 different sweets that they sell. There's the canary creams, the candy in a can, and jumping snakes. Unfortunately, they don't have enough elves to make these sweets. Thus, direct labor hours is the constrained resource. This is the data for these sweets. So we have the selling price for each, we have the variable cost per unit, and the hours to make the candy. Now, what we need to do in these cases is find first the contribution margin and the contribution margin per constrained resource. So first, we're going to do the selling price per unit minus the variable cost and get the contribution margin for all of them. So we can have, here we got 2.25, 2, and 1. If we just do until this step, we will say that the canary creams are the most profitable because they make 2.25, but we're not done yet. We also need to divide it by the constrained resource and see which one is more profitable. So we need to divide it, the contribution margin divided by the hours to make the candy. And then we will have 450 for the first one, 5, and 4. And this is when we rank them. So the most profitable one is the candy in a can because it makes $5 per hour. The canary creams $4.50, and then jumping snakes $4. So as we said before, they don't have enough elves to make all these candies. And these are the demand. There are demand of 200 units of canary creams, 180 of candy in a can, and 150 jumping snakes. But there are only 200 hours available each month. So let's see how many candies they have to make and which ones they have to stop making to make it more profitable. What we're going to do is we're going to divide the demand units and divide them by the hours to make that candy. So for the first one is 200 divided by 50, or well, half an hour, and that's 100. So 100 hours to make 200 canary creams. Then we do the same one with the second one. So it's 72 hours and 37 hours to make the 150 jumping snakes. If we're going to concentrate first in the first one, that is candy in a can, it's only $72, 72 hours versus 200. So if we take 200 minus 72, we still have 128 hours available. And we're going to continue with Canary creams because that's number 2, and it takes 100 hours. So if we subtract that from 128, that will leave us with only 28 hours available to make jumping snakes. So we need to find out how many jumping snakes they will have to do to use all these 200 hours. So we can do the 28 hours divided by 0.25 hours, and that's 112. So if they do 112 jumping snakes and the 180 candy in a can and 200 Canary creams, that it's a total of 200 hours of direct labor, and it will be in the most profitable way. So I hope that will make more sense for chapter 11, and just let me know if you have any questions.